Retailers globally spent the last year navigating severe macroeconomic volatility and disrupted supply lines. Against that turbulent backdrop, Spanish fashion group Inditex posted another year of unbroken, accelerating growth. Inditex's 2025 fiscal year revenue built to a total of 39.9 billion euros, with online channels contributing 10.7 billion. In the fourth quarter, a trend line reveals gross margin climbing by 84 basis points, driving 2.1 billion euros in EBIT. These metrics exceed consensus expectations. They are the direct output of a highly disciplined, non-traditional operational architecture designed specifically to protect margins. The company's foundational advantage is proximity sourcing. By locating over half of its total production in countries near its headquarters, Inditex strictly compresses its manufacturing lead times and reacts immediately to shifting fashion trends. This is a dual-axis line chart, comparing two metrics that normally rise together. For Inditex in 2025, constant currency sales climbed by 7%, crossing a descending line that tracks total inventory dropping by 2% down to 3.2 billion euros. Operating with a reduced inventory base neutralizes a major retail vulnerability, the need for deep seasonal markdowns to liquidate unsold stock. This structural agility acts as a defense mechanism. Even when localized geopolitical shocks disrupt traditional global supply lines, the integrated proximity model allows the company to absorb the friction and maintain its profitability. While Zara remains the largest revenue driver, growth is increasingly powered by portfolio diversification. Brands like Bershka and Stradivarius capture younger demographics, while Oysho aggressively targets the expanding athleisure market. Inditex is also mobilizing Lefties, its ultra-low-cost brand. Originally created to clear Zara's excess inventory, Lefties now operates over 215 standalone stores and is expanding into France and the UK to siphon price-sensitive consumers from fast fashion competitors. Parallel to this brand diversification, management executes a counterintuitive real estate strategy, aggressively closing smaller physical stores to operate fewer but significantly larger locations. This data plot tracks a 3-year divergence, proving the strategy's efficiency. The top line shows a 22. Europe and Spain remain the undisputed center of gravity for the entire business. This donut chart maps global revenue, heavily weighted by Europe at 67% of all sales. Outside that fortress, market share is eroding. The Americas slice shrinks from 19.6% down to 17.8%. Concurrently, the Asia slice compresses from 16.9% to 15%. This regional imbalance is driven by aggressive local competitors in foreign markets. Accelerating growth outside the protected European perimeter remains a distinct operational challenge. That geographic friction has not slowed current momentum. Between February 1st and March 8th of 2026, sales jumped 9% in constant currency, a metric that strips out exchange rate fluctuations to measure true volume growth. Forward guidance dictates a strict 5% increase in gross retail space for the year, alongside a mandate to keep gross margins stable within a tight 50 basis point window. The only notable headwind projected by management is currency devaluation, which is expected to trigger a minimal negative 1% impact on total sales. By integrating multi-brand market reach with ruthless low-inventory supply chain agility, Inditex continues to engineer its own safe haven in a volatile retail sector.